Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show, Danielle.
Hey, thank you, Jim.
Danielle, Evergrande, or some people are now calling it Evergrande. I guess in Chinese it would be something completely different from that. But however you pronounce it, I was going to say, is it the canary in the coal mine, but more the walrus in your bathtub?
Well, I think there's some lessons in Canada here, for Canada in that story. You know, if we look at the excesses that have built up in the property sector in China, it's really been legendary, especially over the last decade since the commodity cycle burst and, the credit bubble in the United States burst and consumption plunged in the world, and then China doubled down on fixed asset investment in its own country, as well as boosting the property market and trying to boost home ownership and all that. Very similar to what Canada did and Australia did as well, to try and revive GDP in the country. And so what happened was, rates got cut to extremely low, lending standards were very weak, everything was backed by the central banks and encouraged by the government policies, and we saw a huge balloon of money go into these property sectors, in particular the residential sector. So what we see with Evergrande is it's, one of the largest developers in the world. It's like 122nd out of the top 500 companies globally for revenue. And it became in the past few years, essentially, like I describe all the time, it's a form of a Ponzi when a company can't actually pay its operating expenses out of its cash flow but has to continually get new investors, new money to come in order to just cover its operating costs. That's what's been going on in Evergrande. It became the most indebted developer in the world, and in the process, it really overbuilt the sector. So there's something like 90 million empty properties, residential properties in China right now. And a lot of the citizens were accessing cheap credit and loans to purchase properties that they couldn't actually afford to live in. So, they maybe put down a small amount and take out a big loan to try and, get this as if it's an investment. And a lot of this has to do with the fact that the Chinese stock market burned its citizens so badly in the past few years that there's just one calamity after another. And so they really said, okay, well, we don't have a huge social safety net. The stock market's been a disaster, so let's double down on housing. Maybe that's going to be, grow us money for our old age. So when everybody starts doing this with extreme leverage, you get this huge imbalance in the economy, and that's what happened. The, property sectors come to account for something like 29% of the economic growth in China over the last decade, and that's about a third. China itself has driven about a third of the global growth in that same period. So this is a massive impact in terms of the whole economy. And of course, for countries like Australia and Canada that export the raw goods that they've been using to do a lot of this building, we've benefited in the short term from that trend, just as we have in our own country with the building that's gone on. And of course, then there's that whole other level of, the Willful Blindness book by Sam Cooper, just the whole moving of money that was in the property sector in China offshore into countries like Canada and Australia. So we've really got this big loop, and now we see the similar concentration in the Canadian economy, where the bulk of our economic growth has come from property development in the last decade. And of course, the imbalances here, the overvaluations are legendary now. So, Canada's property sector, just the residential sector, in terms of the money that has been put into that, has driven about more than 10% of our GDP growth. And, just to give you some context to that, at the peak of the U.S. property bubble, the worst their residential sector ever drove was not 7% of their overall GDP. So we're already about a 30% higher in terms of over-concentration and over-investment in our residential market than the U.S. was in 2006, just before, let's not forget, prices plunged 40% nationally. And it's not just in the United States. It's really every single country in the world that we've ever seen this kind of, massive overinvestment into this one sector on high leverage. It always turned out the same. It's always been a mean reversion period that comes where prices drop and all the heavily layered, of heavily levered participants, whether the developers or the end property buyers, they end up going bankrupt. And so that's what happened with Evergrande in the last, in September. They missed a payment to their bondholders, their international bondholders. So a lot of these companies have issued debt globally in U.S. dollars because they could attract capital inflows from outside. Again, going back to this is required to keep their business model going. So the Chinese government, there's a lot of expectation that they will backstop any losses in the sector ultimately, because they have massive civil unrest, because the employees were all protesting, because of the purview of lost wages, but also because the employees have been encouraged to put all their savings that wasn't in property into shares and bonds of this company. And now as they look at, the company unwinding, they're facing loss on every level. So there was a lot of protest, and the government is very concerned about civil unrest in that country. So there's generally this perception or expectation that, although Xi wants to stamp out this, reduce speculation in this sector and has restricted the amount that developers are allowed to now borrow when they're at certain peaks in debt, all of this is kind of coming home to roost and starting to unravel. And we've already seen the credit impulse in China peak and fall over the last 6 months. And typically that credit impulse, that, when credit starts to contract, it really has a massive impact on manufacturing globally, on, the global credit impulse. So there's a lot of impacts here. And I think that, with CMHC warning this week about the Canadian housing market, it really has this ring to it, which is to say, again, no country in the world in history that has ever overinvested and elevated prices that much in that sector and become that economically reliant has ever got away with it. It's always been a really painful period of payback. So I think that's the risk that we have to sort of try and build into our expectations as we look forward over the next decade.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, is the typical Canadian household way overly exposed to debt?
Sure. Debt and whatever savings they do have, as I say, is in their housing, and then any funds they have after that tend to be in the stock market. And really it's sort of like one trade, because the housing, so the average home sale price in August in Canada was $736,000. The average the median disposable, so after tax household income in Canada, is less than $70,000. So we're looking at, a median price that's some 10 to 11 times the median disposable income, just to give you a sense of it. And so every dollar that people have, they've really put on the housing bet. That's the first thing. And then they've taken on enormous debt in order to accomplish that, as we've discussed. And then at the same time, Canadians have whatever monies they have in retirement savings or their children's education funds typically are in, equities primarily. And right now we see that in households they have record exposure to the equity cycle because prices have gone up so rapidly in the last year, and the public always buys the most at the top and the least at the bottom. So, they have a lot. So when you're owning the Canadian stock market today, you have, 30% weight in the Canadian banks, who are the same institutions, of course, which are heavily levered and have lent so much into this sector, both to developers as well as to households and other businesses. So it's really this loop of pain because as we've seen home sales decline or come off the boil in Canada over the past few months, since the spring primarily, that could be the leading sign that we've sort of topped out on the appetite to buy this the housing trade this time, and that suggests what are we going to have to fall back on here to replace it. And that brings us back to what other sectors we primarily rely on for economic growth in Canada and jobs. And outside of real estate, we've really always had the main three sectors being transportation, auto manufacturing, as well as energy, as well as agriculture. And it just so happens that those three sectors are also in the midst of a massive disruption cycle, which has institutions like Rethinks, who have done a really detailed examination of this, tell us that within 10 years, by 2030, that's 8 years actually, they expect that all three of those sectors to have become massively disrupted by incoming technology. So things like electric vehicles in the transportation space, which, by the way, electric vehicle sales were up 41% year over year between 2019 and 2020 in the midst of the pandemic. 41% growth. And that's still a tiny fraction of what's to come in the next decade. But at the same time, we've got this massive disruption in our animal-based agriculture with precision fermentation, which is now able to replicate most of the proteins in the foods that we've been relying on animals for so many years. And so at the same time, of course, we have energy, which the IEA, the International Energy Association, has recently affirmed that they say gasoline demand peaked in 2019, and they don't expect it to ever go back to that. And although oil prices have rallied in the last month, they're still back to where they were just 3 years ago. So really, pricing here is, there's a short-term crunch right now because of things like Hurricane Ida, which has still got U.S. supply offline and hasn't brought everything back on yet. And the Saudis are, trying to use their leverage here to keep prices high. But at the end of the day, we're going into a slowdown in the global economy again. And the main reasons for that are we had such a huge influx of money, both on monetary and fiscal side, from governments and central banks. It was unprecedented. Trillions and trillions of dollars went in to cause, to reflate the economy out of the 2020 pandemic sell-off, the initial leg of it. And there's just no runway to continue that type of support indefinitely. And so the credit impulse is turned down, the global growth is turned down, and the demand for some of these key commodities has already turned lower. So we see that in things like copper, in iron ore, lumber. These things have all rolled over from the spring. So I think that people are going to be shocked at the fall off in spending and growth that is happening. It's already been underway for several months, but I think people who are expecting that somehow, because we're now, have high vaccination rates in certain countries, that we should see this really strong rebound, I think it's going to be the opposite. Because, as I say, no matter how much we buy in terms of services, if we get some reopening of more reopening, we've already basically reopened the economy, but if we're going to see more positive effects on spending, it's going to be more than offset by this contraction in these other forms of capital that have been coming in on an emergency basis. If you think about it, there's two main things that happened in the last year to cause equity markets in particular and rates to fall in equity markets to rally so much. And they were two really optimistic developments. One was the surprise of the vaccines coming before people had thought possible in the fall of 20, like last year. And the second thing was this, the Democrats won the runoff in the elections in Georgia and gave them a one-vote majority for the Senate. That was confirmed in January. And those two things caused this big, massive switch of optimism, like suddenly they were going to be able to push through their infrastructure spending, unlimited infrastructure spending, and that we were going to see a rapid end to the pandemic because of the vaccinations. And of course, those things haven't happened. So we've had this euphoric pricing that's gone into reflating and causing stocks to double in 1 year. And, corporate earnings to leap on the sudden spurge of spending and money they received as well as support. And then all of a sudden now we realize, wow, even in the best case scenario where now we have 80% of, for example, Canadians vaccinated, et cetera, we still have ongoing problems. We still have, challenges with the virus, but we also have challenges with the economy in terms of having a lot of businesses missing and a lot of questions about where our growth is coming from here and a lot more debt. So we haven't solved any of the problems. We've really sort of kicked the can, added more debt. We still have to really go back to the drawing board about how to reinvent ourselves, how to make, just carbon tax, for example, is jumping to $50 in 2022 and going up $15 a ton every year thereafter. So between now and 2030, the price of carbon emissions is going to go up to $170 a ton. It has to, because we have to stay competitive and try and meet these targets globally. But again, if you look at the sectors right now that are going about their merry way, barely breaking even, by the way, in a lot of cases, because they're just basically, as I say, requiring new money to come in to keep them afloat. And now we're not even talking about the correct pricing on their impact in terms of the carbon they're emitting. So this is going to be the most disruptive decade of my lifetime, I have no doubt. I think of most people's lifetime. I think there's enormous change and opportunity coming in this, but it's going to be a complete 360 degrees from where we are today in terms of where the growth is. And that's why I think that the things that have become so dramatically inflated are really bets on the wrong horse here.
Danielle, I'm sure we could talk forever here, but you have a very busy schedule, so we thank you so much for chatting with us today.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Check out her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our guests, we'll ask that question for you if you send it to info@howestreet.com. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.